Our next guest suggests, excuse me, the Fed has not materially broken anything yet, and more banking turmoil could be ahead. Stuart Sopp is CEO of Current, a fintech company. Stuart, you've been sitting here listening to our conversation. What would instill confidence in the banks for investors? I mean, is it blanket insurance? Does that make you feel better?
I think it is important to look at what's going on right now. The banks that are going down and in receivership are primarily business banks, Silvergate, SVB, Signature. And so they have a deposit concentration that is primarily through like either a crypto angle or like a startup angle. And of course, they have deposits that are way bigger than the 250K FDIC insured. So they're able to move that money very quickly. And also, given the backdrop of how startups and the business conditions are, they're very sensitive to some of these conditions. So I think in terms of like the business banking community, there's very little we can do right now other than some of these guarantees that are going on. I think there's a very different story for consumers at this point.
Yeah, I mean, it sounds like you can't make a set of rules to guard against stupid risk management of your own portfolio, right? I mean, that's just, you can't.
No, we talk about it all the time. Stuart, in a past life, you were a bond trader, you were a currency trader. I mean, those go hand in hand. What do you make of some of them? Tim was just talking about some of the absurd moves we've been seeing over the last couple of weeks, but literally over the last couple of years.
Yeah, some of these interest rate moves are insane. We've seen some of the hedge funds that have recently gone down. So there's professional pain as well as consumer pain. When you think about the consumer, a lot of people who are living paycheck to paycheck are on variable rate mortgages, variable rate auto loans, credit card debt that is now north of $1 trillion. Now, if you squint, it is back on track in terms of like, you know, the curve that we were on, the slope that we're on, but it is excessive. So the thing that worries me right now is the interest rate volatility that infers the equity, the profitability of some of these banks. That's the thing to look for right now. And looking at the consumer, as we go forward into Q2, Q3, I'm a little bit worried.
Talk to us a little bit about that. Like to Guy's point, I know you were a macro trader during the financial crisis. Yep. So going back, 15 years or so. So now you built a fintech company that is actually competing with the incumbent banking system. So when you think about the environment that we're in right now, does it feel fragile to you if you put your old trading cap on versus now as a builder and trying to challenge these incumbents? I'm just curious because you just heard us talking about it. Like, we're not trying to like create some sort of fear about the situation. I have a lot of scar tissue, as many of us do as investors or traders, from that period 15 years ago, and some of it's kind of bubbling back up. I'm just curious, like, how is this affecting you and what you're building?
Yeah, that's a good question. So with my macro trading cap on, I would say squinting at the Fed, I think Powell's doing an okay job. I know not great, but an okay job because he raised 25. He'd had his Volcker moment yesterday. We're seeing non-systemic bank runs. There's sort of idiosyncratic in one after the other. And so as I squint from a macro perspective, I'm like, this is okay. And I think they're firming, which is liquidity plus tightening. That's what firming means to me. So I think there's more pain to come. So from a macro perspective, I'm saying, okay, there's going to be more bank runs. Regionals are more fragile than the big money market center banks, and we're going to see more pain. And I think the Fed expects more pain, especially the Treasury as well. From a consumer standpoint, that's a little different. I think there's a little bit more to worry about. And from a tech CEO standpoint, the SVB event was highly, highly disruptive and extremely painful at the time.
But from a fintech perspective, is it good that people are questioning their traditional banks at this point, or does it all just go to a JP Morgan or Bank of America?
I think for most consumers, they're going to make a choice if they're over 250K FDIC insured, or whatever the new number is going to be, right? Clearly, that's up for grabs. For the majority of Americans, they don't really have that kind of money, and also they feel fairly protected with either a fintech or a regional or even a money center. Just remember, money center banks, the reason why fintechs exist is because they don't serve the majority of Americans properly. So that's why we exist.
Stuart, thank you. Good to see you.
Thank you.
Stuart Sopp. Tim, what do you think?
Well, I think part of the issue that we're not addressing are consumer credit issues that I think a lot of, and again, fintechs are many different. It's a big classification that could really be disruption in terms of access to products. Doesn't mean they're taking credit risk per se. There are a lot that are. And I think investors really need to do their homework because the first round of the market sell down was sell all fintech because these were high multiple tech stocks in many cases didn't make money. I think there are some out there that have a lot of credit exposure. And, we're going to talk more about Block, the buy now, pay later garbage that I think a lot of people invested in is something that is right in the crosshairs of consumer credit. The big banks have never been stronger in terms of their balance sheets. I think they're fine. I think what we're all saying, and I saw it second one, they are derating as we speak. You can't own these things like you could 2 months ago. And I was a big believer that the money center banks were game on.
Okay, so they're derating, but do they deserve a re-rating?
What's the difference between D-rating and re-rating?
D-rating is just your P is going down, what your worth's going down. And that may or may not be a re-rating would imply that there is a new normal, that they have to be judged by a different standard in terms of their operating environment.
I think we really need to hear from them, right? We need to hear how have things changed for them. The massive amount of inflows, for example, when we hear from money center banks, I think that's going to be really important. I think that to the extent that the regionals are so hampered by either fear or regulation or both, that potentially works to the bank's benefit. But if we see regulation applied to them as well, because they're now even bigger, even scarier if they fail, we can't have that. I don't know. I want to hear from them.
More regulation is going to hurt the smaller banks. I mean, Dan said it, Tim, Karen said it. It's fascinating that we were in this era where you don't want banks to be too big to fail. That's exactly what the last 3 or 4 weeks is creating.
Well, and Credit Suisse was one of the 30, right? Systemically important. And Switzerland as a country I mean, think about it. They are the banking capital of the world. And suddenly that was in question.